Okay, picking up now where we left off. This is part two here on order entry. Some brokerages break down your order entry a little bit differently. Like, for example, here's one. Here's your buy, sell. The drop down menu. You tell the system if you're going to be buying or selling. Number of shares. Here's your symbol. Here's your order type. This one, stop limit on quote. And basically that's the same as your your stop limit, and you tell it what price you want, whatever. So the way to enter a stop limit correctly is, first of all, your stop, if you're buying, if it's like you're going to buy this right here, let's say for instance this says the last price is 206, and let's say you're going to buy it if it gets to 210. You put right here in the stop price 210. The limit price is how much slippage you're going to allow. So let's say for the sake of this example, you're going to put the price here as $2.15. So your stop price has to be above the current market price. So we're going to put 210, and then your limit price will be 215. So once the market hits 210, your stop order becomes a market order, but has a limit attached to it, meaning that you can fill me at my stop price, but you can't fill me worse than my limit price. So if my stop price is 210, you can fill me anywhere between 210 and 215. All right, that's how that works. All right, and in a rare occasion, you can even get filled less, depending on how the market is behaving and things like that. All right, then it's the duration. So this is today, meaning a day order, good till canceled, or even good till date. Now, good till date, most that's really a forex type of a situation. Most forex brokers allow you to put an order in and leave it into a date if you want. So you can let the order run all month, or you can let it run all year. You can, it's whatever. It's whatever you put in there, whatever they allow based on their calendar and available dates. But good till cancel is the same thing. It's just saying it's going to work, sit there and work until you cancel it, no matter when that is. So that's just something to keep in mind too. All right, so getting a further look here. Here's under the order type. Here's a market. We talked about that. A market order is just what it says. It's a market order. As soon as you press market and you hit send, it's going to execute the trade immediately. Whatever the price is between the bid and the ask, you're going to get filled. All right, that's what that means. Okay, whatever that bid to ask spread is, that's where you're going to get filled. And in a good, solid, liquid market, your bid to ask is only going to be a penny or two, to be quite honest with you. It shouldn't be dollars. That's a very illiquid market. When it comes to equities, if you see a bid to ask, that's dollars, then that's a highly illiquid market. You need to run. Notice here, it's only a few pennies, okay? It's 201 and 207, so there's a 6-cent spread there. All right, which means you can be filled anywhere in there. Okay, the 207, your ask is what the seller is asking that you buy it at. So the market's at 206. If you want to buy it, it's saying you got to buy it at 207. That's what it's saying. All right, and then here's the bid. This is currently what someone has a limit order in to buy the market at, because this bid is under here, and that's a 201, which means that this is a limit order and they're trying to buy a pullback from this price. So again, here's your spread. This is what they're trying to do. So you got the market's in at 206. You can try to get it at 206. A market order is going to fill you immediately regardless of what it is. Just keep in mind that in what is called fast markets, in a fast market, technically speaking, and I can only tell you what I have experienced in real life, you can be filled at any price. Technically speaking, the dangers of a market order is you can be filled at any price. Literally, wherever the market trades, you can be filled. So if you hit market order and the market's currently at 206, but something happens in that by the time you place your order in the market, you could be filled at 220. You could be filled at $5. You could be filled at $10, $100, if that's where the market jumps to and trades. Keep that in mind. And in a fast market, you may not get filled at all. Technically speaking, the law says that the broker, the flow broker, if he does not have to fill any orders in a fast market. They fill what they can, and that's it. A fast market means that so many trades are coming in, so many tickets are hitting the trading floor that the brokers can't keep up. And sometimes trades will slip through the cracks. I know that if you were to talk to an educator, they would say, oh, that's not true. In a fast market, this means that it's fast and, we can't guarantee your price. That's a lie. I'm telling you, real life, I'm still waiting for my tickets and natural gas, crude oil, and cocoa from 2000, 2001. Where are my tickets at, man? Huh? Market orders. Where's my money? Where's my tickets? All right. It is what it is. I'm trying to tell you that in a fast market, they do not have to guarantee you a fill at all. And most of the time, you're going to get filled at the worst price. If you're buying, you're going to get filled at the high of the day. If you're selling, you're going to be filled at the low of the day. I'm just giving it to you straight. So market orders are at your own risk. You hope that everything is cool when you put the order in. Now, don't get afraid. There are times that you need to use a market order. And when those times come, you take advantage of it. Sometimes you have to mark it out or mark it in. You have to. It just depends on the situation. But for the most part, we're not going to use market orders. For the most part, we're going to use stops and limits. All right. That's why I like Thinkorswim, because Thinkorswim will allow you. Let's say I'm holding, whatever the number of shares is of this particular stock. Okay, the Brazil Resources. Let's say I'm holding it. What Thinkorswim will allow me to do. And let's say I don't have a stop working. I'm just holding this because I'm like, okay, it's a $2 stock. What's the worst that's going to happen? It's going to go to zero. Come on. Unless the company's going out of business, that's not going to happen. Seriously. All right. So what? You can buy a $2 stock and sit on it forever. You don't need to stop. But let's just say that's what I'm doing. I have no stop. I'm long. All right. What I can do is with Thinkorswim, I can click a button and it'll say, liquidate current position or close current position, and it automatically will put me where the current bid ask is, and I put it as a limit order, and most of the time I'm filled instantaneously at my limit price, which is tight. So you can get in and out. Liquid markets, you can get in and out, and you can get in and out at a pretty good price, so you don't have to sit there and sweat over it. All right, here's stop on quote, stop limit on quote, and trailing stop on quote. This is just a nice way to say stop, stop limit, and a trailing stop. Forget the word quote. It's the same thing. A stop, meaning that if I was going to buy this at 210, I'm buying it at 210 on a stop. The 210 is my quote. That's all that means. If I'm doing the stop limit, I'm buying at 210 on a stop, 215 limit. That's what all the quote means. Trailing stop. If I'm already long this, let's say I was long from a dollar, and I want to move my trailing stop to, let's say, $2 even. That's my trailing stop. I'm gonna sell it if I'm hit at $2 on a stop. That's my quote. $2 is my quote. That's all that is. Just a fancy way to do it. That's all. All right. This is where we get into the nuts and the bolts. This is very, very important. And this is going to vary for most of you because it depends on what broker you're using. It depends on what jurisdiction you're in, what continent, what country, what your securities laws is. And it's also going to depend primarily on how did you set your account up. Some of you will not be able to sell short because of the way you set up your account. You're going to need to change it. People's needs do change. So brokerages will allow you to change your investment objectives. How you set up your account is so paramount. You basically, if you want to be able to trade everything and be on margin and trade options and all that stuff, You basically have to tell your broker that you are Mad Max beyond Thunderdome. Tell them that you are about appreciation of capital. Forget about so don't say, I'm looking for growth. I'm looking for conservative. I just want preservation of capital. Those are key words to say that you're risk averse. You got to tell them I am not risk averse. I am a day trader by nature, and I'm looking for high risk. That's what you got to tell them. You got to tell them specifically, I want to trade stocks. I want to trade options on stocks. And if your broker allows it, I want to trade commodity futures, options on commodity futures, and forex. You literally have to tell your broker that you want to trade all the things that they have available. You need to do that. All right? You got to. But then here's where they get you. Because, see, again, the government feels they have to protect you from yourself. So here's what they do. They ask you about your experience. How much experience do you have in trading these markets? I got to tell you, for the most part, you basically, I don't, for a better, there's no other way to say it. You basically got to lie to them and tell them that basically, I got 5+ years trading and, whatever, 10 years trading, and yes, this is what I want to do. Because it's really stupid how they try to hamstring you and tell you what you can and can't do with your own money. Now, granted, everything we do by law, and I wouldn't be fair if I didn't explain this to you. Everything we do is considered high risk. All right. There is risk of loss in trading, even in my method. Even though I designed it, to be simple and to be smooth, it doesn't matter. All right. Things can happen in the market, and you could lose all of your money. Okay, if you're trading stocks, you can lose absolutely all of your initial investment. All right. If you're trading futures, you can lose more than your initial investment. If you're trading forex at a traditional forex shop, they run it like stock, so you only lose what your initial investment is. But some of these forex outfits, especially the ones that allow you up to 200 to 1 or 500 to 1 leverage, technically speaking, you can lose more than your initial investment, just like commodities, just like trading futures, commodity futures. So it depends on the amount of leverage and what you're doing. But just for the sake of general disclosure, when it comes to trading and even in traditional investing, you can lose even more than your initial account, and that's just a fact of it. We accept those enormous risks because with enormous risk comes enormous reward. So you got to remember that too. When it comes to trading commodity futures, you can make $1 million in a day, literally, but you can also lose $1 million in a day. All right, so that's just knowing the playing field and being wise and understanding what you're doing and what you're getting yourself involved in. Remember, we cannot avoid risk. We manage risk. How do you manage risk? You manage risk by using stop losses. All right, that's what you do. If you know your risk is unlimited in a trade because you're trading commodity futures or forex, where they don't automatically take you out of the position, so you can lose more in your initial investment, and they say so in their writings. Well, you know what? You got to use a stop. Now, does a stop always protect you? All right. I have to tell you no, only because in volatile markets and fast markets, the market can blow past your stop or even jump and skip past your stop. If that happens, then yeah. If you only was risking $100 on a trade, you could end up losing 500 or 1,000 or whatever. Those are rare situations that can happen, but they are rare. You don't see the markets jumping and skipping like that every day. You don't. For the most part, they're generally tame and quiet and smooth, and that's just the way they're set up. But yes, we can have flash crashes. Yes, we can have parabolic moves. We can have 9/11s. We can have Brexits. If you're trading equities, there could be news that comes out about a company that you're trading and makes the stock go berserk or whatever. Anything can happen. But we manage those risks by using stop losses. It's better to use a stop loss and minimize your risk of loss than to not use one at all and be open-ended and have unlimited risk. You see what I'm saying? So I have to put that out there so that you all understand. But then I go back and let you know that I designed the pulse wave system to minimize that. Yes, I use volatility stops. What is that? What is a volatility stop? Okay, so what is or what are volatility stops? Volatility stops is what I call the stop losses that I've programmed in the pulse wave system. Volatility stops, they ebb and flow with each and every market based on certain market conditions. Sometimes the stops will be wider when there's a lot of volatility. Other times the stops will be narrower where there is not a lot of volatility. So they move and ebb and flow with the market. Now, with that comes, of course, different levels of risk. During periods of high volatility, you will have higher periods, wider stops, thus wider risk. Lower volatility, more narrow stops, less of a risk. But as you know, for sake of argument, for those of you who are new to trading, there's always risk in trading. I don't care what the market is. I don't care if it's corn. There was a time we used to make a joke about corn futures because they barely moved, but that is not the case anymore. Corn could rip your face off just like any other asset or security. So, with that being said, looking at the screen here, you can see the different order types again. Here's buying, here's selling short, and here's buy to cover. And like I said, based on how you guys set your accounts up, you may not be able to sell short. That will severely limit you or hamstring you. Can you still make money with the pulse wave system? Absolutely. All right, you can make money just always taking the long side of the market, but in bear markets, it will severely limit you. All right, if a market's in a bear market and it's crashing, let's say it's a $700 stock, and it ends up falling down to $100, that means you have to sit on the sidelines for the entire drop, no matter how long it takes, because you're in a bear market and you're missing out. So do yourself a favor and set up your account so that you can sell short as well as go long. Make sure it's a margin account. And like I said, make sure your broker has all the different order types. If they do not, then may I highly suggest you switching over to Thinkorswim or Interactive Brokers. I know because a lot of you are, located overseas, you may or may not be able to open with Thinkorswim. I don't know if they have overseas stuff, but I know Interactive Brokers, to my understanding, you can trade with them all over the world. So if you can't do Thinkorswim, by all means, go to Interactive Brokers, please, and set yourself up so that you can trade on on margin and be able to trade all the different markets and all that stuff. Okay, just open yourself up to that, because if you don't, you're gonna be limited. Another neat thing is too that most brokers should be able to set you up like this. See, if you're holding something, it's gonna or not, it's gonna here's your action: buy, sell all shares, specific shares. You know, when you're buying, X amount of something, you can always leg yourself into or leg yourself out of a position. What do I mean by that? When you're legging yourself in, you may start off, let's say you're starting off with 100 shares of, let's say, this First Majestic. And then as it hits another price point, you buy 100 more shares. You're always, legging yourself into a position like that. And then you may get full position. Let's say your full positions are going to be no more than 500 shares. Well, then once you get to 500, then you're not adding anymore. You're now fully positioned. And let's say you get to a point where, let's say in this situation, it goes from $12 to $25, and you want to now start taking some profit off the table. Instead of just selling all your 500 shares, sell all shares, you may only sell 200 shares. Well, you can specify that under the sell and the quantity. You just put sell 200 shares. Boom, you're done. That's how you do that. Now, let's talk about another aspect. You can see some brokers allow you, different things. Here's your market, limit, stop limit. And then they're trailing. They offer trailing stops. Trailing stop loss on the dollar amount, percentage, stop limit dollar amount, stop limit percentage. You're not going to really be dealing with that. I don't like those. I don't use these trailing stops. I use my own trailing stops. I let the system tell me where to put the stops at. So that's how I roll. Okay. Just FYI on that. Just want to let you know that's what that is. Okay. So you're not going to be using these here at the bottom. All right. Let's see. Again, more order types. Here's good till cancel, fill or kill, immediate or cancel, on the open or on the close. Okay. Fill or kill, meaning that, let's say you wanted to sell a lot of shares of something that you owned. Basically, what it's saying is, look, I want to sell, let's say, 10,000 shares of this. Fill or kill means if you can't do all 10,000, then just forget the order. I want to do all 10,000 or nothing. That's what that's saying. That's the fill or kill. All right, immediate or cancel, pretty much same things like the fill or the kill. You're saying I want to do whatever the action is immediately, and if you can't get it done, then just forget it. On open and on close is another way to say market on open, market on close. What will happen is you can put an order in for the opening of a market, and you say you want to go market on open. What that means is it's going to fill you somewhere between the opening price. It's going to be a range, somewhere between the opening price, whatever that range is, and there's a risk that you could be filled with the difference between the opening price and the low of the day, or the opening price of the high of the day. All right, if you're buying, it's probably going to be between the opening price and the high of that opening range. All right, so just keep that in the back of your mind as well. All right, anything else on here I need to address? Let's see. Nope. I think that's it. So remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can, give nothing back.